Good morning from London. I'm Anna Edwards alongside Guy Johnson and Lizzy Burden. We're an hour away from the opening trade. Here's what you need to know. The global relief rally loses steam. Futures edge lower as Asian stocks snap a 5-day winning streak on mixed China tariff signals from the White House. BNP equity trading soars in a strong morning for European earnings, with Nestlé, Roche and Sanofi all beating some estimates. Plus, more trouble at Gucci as Kering's key brand reports another drop in sales amid softening demand for luxury.
Good morning. Well, it's tariffs on, tariffs off, and the mixed signals are not what this market wants. Clipping the wings of that stock rally, as you say, Anna, and futures pointing lower on both sides of the Atlantic this morning. Same story over in the Asia session. The dollar weakening again, so euro dollar up 0.2% at a 1.13 handle. Lots of earnings to factor in, but the countdown to the opening trade starts right now.
Thursday the 24th. Good morning, folks. The narrative this morning is very much that the markets have tamed Trump, that we are going to have some predictability going forward from here, that we're going to get an understanding of what is going on with the tariff story and maybe get some confidence in where ultimately we are heading, what paradigm we are heading into. That's the positive spin, Anna, and that is what has delivered 2 days of back-to-back really strong gains for US equities. Yeah, today we're wobbling a little bit. We never go in a straight line. But the last few days, the last 2 days in particular, from many in the market, have felt like a game changer.
Yes, and is it the markets that are taming Trump, or is it corporate America? I know they're linked, but we've got some interesting reporting suggesting maybe that meeting with the retailers really cut through. Retailers warning President Trump that there could be empty shelves in a couple of weeks, and that isn't something that he would want to see. So maybe that had an impact. But just to recap some of the twists and turns, as you said, the tariffs on, tariffs off conversation of yesterday, we heard that lightness from President Trump. He's talking about, we're going to get along with China. We'll get a deal in 2 to 3 weeks. The US is having direct contact every day with China, was the message from President Trump. And then Scott Bessent, the Treasury Secretary, a really different message. The US has not offered to reduce tariffs unilaterally. A China deal may take 2 to 3 years. 2 to 3 years is a long time in the market's mind. And we've been talking up to this point about 90 days to get trade deals done. He also said that Washington is not yet talking to Beijing. So a lot of mixed signals.
It's an interesting thing that Bessent is the one who kind of clipped markets, because everybody's been trying to make sense of what makes a good day, what makes a bad day. And Neil Dutter over at Renaissance Macro had made this chart showing that when Bessent speaks, it's a good day. And then when it's Lutnick or Navarro, it's a bad day for markets. But actually, Bessent must have heard, because he blew it out of the water.
Where does Trump fit into that?
Yeah.
He's the one that ultimately makes all the decisions. He's the one that ultimately is driving this process. He can change his mind. He will change his mind. He's certainly shown evidence of changing his mind. And you do wonder whether that is what has happened over the last couple of days, that he's looked at what has happened in the market reaction. He's heard the voices on his shoulders talking to him about the damage that is being done from a market perspective, and has changed course as a result of that. Yes, the retailers are probably in on the conversation as well. But if there is a degree of certainty coming back in, Valerie and I were discussing this before we came on. There's a degree of certainty that is something that markets can deal with and understand. Is that where we're heading? 100 days is next Wednesday.
Yeah.
He needs to get things done by then. He needs to have things to show by then. And I'm wondering if that is the phase we're now going into.
Yes, if this is peak tariff, and if the direction of travel is only downwards in terms of tariffs, even if we don't have the certainty about where they land, then at least that is maybe something the market can work with. Thinking about tariffs takes us nicely onto the drug conversation, the earnings reports coming through from some of these companies this morning, Guy. And Roche giving, previously we'd heard from Roche that they were investing more in the United States. Well, they're certainly not pulling back their investments in Asia and in Europe. Lots coming out of the drug makers this morning.
So it's interesting. Actually, I'm just trying to get through the Sanofi comments and get exactly what we're getting there. But yeah, the view from Roche is that there's no plans to cut back in manufacturing or Asia. Now, that doesn't mean that there isn't a shift in policy that is ultimately taking place here. They're talking about continuing investments in China, which is something they've been talking about for quite some time. They have been building up capacity in the United States to manage the tariff story, so they have built up inventory around that. And it's going to be interesting to see how they manage this. They have moved production for some drugs to address tariffs. So there is, while there is no change, there is a shift. So they are managing this tariff story quite strongly in terms of what they're doing at the moment, both with inventory and production potentially moving as well. You've also had Sanofi out as well. That is one to watch out for too. It is out with very strong numbers. Its stock looks like it's going to bounce quite strongly at the get-go this morning. But we still don't know that there's still this Trump story hanging over this sector of the market. He wants to change pricing on drugs in the United States. We don't have details on that yet.
Yeah, I mean, you had that letter from the Sanofi and Novartis bosses in the FT yesterday saying, you know, the European price controls and the austerity measures are kind of reducing the attractiveness of these markets compared to the US levels. You need to get those drug prices to increase to those levels. So the other side is the negatives on Europe. We've also had results from Nestle as well, of course, the world's biggest food company. Shares up 17% year to date, and they're actually saying that sales have climbed on the higher prices for cocoa and for coffee products. So very much as expected, and kind of showing off a little bit about how they're able to adapt to this tariff environment. So someone that is affected by it but is able to weather the storm.
Right, well, pricing power. During COVID, we were all talking about the distinction between businesses that have pricing power and those that don't, and so maybe we're back to talking about that. Let's go to BNP Paribas in the banking sector, because we also had numbers out from them this morning. And the lightness of this story, the positivity of this story is equity trading. So just like the Wall Street banks, they've managed to do really well there. In fact, they've done better in terms of the year-on-year gains in equity trading, up by 42%. Year-on-year. Wall Street's average was 34%. And loan losses have come in lower than expected. So for those worrying about whether any of this is taking a toll on the customers of these banks, then maybe not yet at least. There is perhaps a little fly in the ointment in terms of costs. And so when we speak to the management of BNP shortly, we'll certainly get into that conversation.
Can I just add a few more flies to said ointment? They are doing well on trading at the moment. Why are they doing on trading? Because there's a lot of uncertainty. There's lots of really big swings in these markets. Assume that we're going into a lower volatility environment. Does that mean that some of those maybe extra earnings that are coming through from the trading
Feels
books...
like maybe the first question, how sustainable is this performance?
Well, precisely. That's always the first question when it comes to any big beats on trading. But also the ECB's cutting rates, so you've also got a headwind that is coming potentially there. We've heard from a series of ECB speakers over the last 24 hours. There is no inflation in Europe. We have a green light to cut rates. We could be cutting rates quite aggressively from here. That's going to be a headwind as well.
Which is a much more direct signal, just a much more clearer position on inflation than we heard from Lagarde when she was speaking in Frankfurt. She was much clearer on growth than she was on inflation. Let me just come back to earnings, though, because we also had Kering after market yesterday. So the sales dropping 25% at Gucci in the first quarter, slightly more than expected. So we're still waiting for this revival of Gucci, their biggest brand, of course, where they get 60%.
Who's the new designer?
Profit. Demna.
That's his first name, right?
So he's come, and he goes by one name.
Balenciaga, he's come from there.
Oh, Guy, you've been reading up. Showing off.
What do you mean I've been reading up? I know this stuff naturally. Of course.
But look, that isn't going to take effect until September, till the show in Milan. So we're not going to see this turnaround, if there will be one, until the second half of the year. So for the meantime, you've got Kering really suffering more than LVMH or than Hermes, although tariffs hurting everyone in luxury.
Now you've got to talk about shoes, footwear.
So what is it? What are the ones I need to be knowing about?
I can't remember.
No, you know.
I just go out and buy everything that Andrea Felstead tells me to go out and buy. Last time she was on, she said something about specific.
There were new Nikes that she was talking about. The kill shot, the tennis ones that apparently she was talking about would be the next sneaker that would take over. But it looks like Adidas is still doing well.
Yeah, retro trainers.
So the sneakers that it's been pushing out, the Sambas, etc., have been doing really well and continue to do well. And you can see that in the earnings. So the earnings last night that were delivered were not the full earnings. We've got to wait for a week. This is a kind of first look, which I always love German companies doing.
Thanks so much. Especially when they come as a surprise. I'm not sure if this was a surprise.
No, I think we should assume that it's not a surprise, but because they do it every time. Anyway, the numbers look good. The stock looks like it's going to be surging quite nicely. There you go. There's a pair of gazelles, which apparently are continuing to sell very, very well. So the fashion story is continuing to do well, despite a lot of these brands are trying to push, and Nike's definitely doing this, pushing more firmly back into the athletic sports side, running shoes, etc. And that is where they see the advantage being. And it's interesting that Nike saw... It felt that it, with the move to the Dunks and the Air Force Ones, went too far in the direction that maybe Adidas is doing right now. Adidas is doing very well off fashion. Does it need to reposition? Will it at some point need to reposition back to sport?
Shall we get into a conversation
about
the... Are we done on fashion? fashion and footwear. Let's talk about some of the things we've got coming up. We've got a load of guests.
We do. We've got some guests coming up that are going to be talking about some of the stories we've just been discussing. Lars Machenil, the BNP Paribas Group CFO, is going to be joining us. Nicholas Osberg, Delivery Hero CEO, is going to be joining us a little bit later as well. We'll talk about what is happening there. We need to talk about what's happening in the bond market. Is it all over? Laurent Van Billon is going to be joining us, Allsprings Global Investments Fixed Income Portfolio Manager. And Sharon Bell, Goldman Sachs Senior European Equity Strategist, is going to be joining us too. Plus, did you see the big fine? Was it that big that we saw yesterday coming out of the EU for some of the big tech companies out of the States? Zach Myers, Centre for European Regulation and Research Director, is going to be joining us. Was that an olive branch? I don't know. We'll discuss that a little bit later. The fine wasn't that big. Yeah. Maybe it's part of the trade narrative as well.
Yes, exactly. That's the speculation this morning from various voices certainly in the UK media. You know, is this part of that overall overarching trade conversation with the United States? Is it designed to placate President Trump? Should we talk about what's coming up?
Yeah, at 9 a.m. London time, we're going to get the German IFO numbers, usually seen as one of the most reliable early indicators of economic activity in Germany. Then 1:30 p.m. London time, we get US durable goods numbers, jobless claims as well. 6 p.m. UK time, there's another Treasury auction. This is the 7-year note auction. And then aftermarket, Intel and Alphabet earnings as well.
We've heard a lot from Intel already, haven't we?
Are we going to get these job cuts?
Story.
Are we going to get these job cuts?
Yeah,
I think it's the critical
CEO
thing.
in position, taking on Nvidia to better effect. And Alphabet, I'm really interested in this. After our conversation yesterday with Lion Trust, we were hearing from our guest who was very sceptical about the way that Google search can stand up to AI and how quickly that narrative is developing. I think it's a really interesting one to watch.
Yeah, if you use traditional search, are you just kind of too old school now?
Yeah.
Is it a sign of age that you Google something or even talk about Googling something?
The box isn't big enough. If they want to compete, they just need to make it a bigger box to invite to question.
We send feedback. We have guests waiting in the wings, so we should get to some
We do. So let's
stories.
talk about what else you need to know. What is it, Thursday? Yeah, Thursday. This week's confusing. European car sales returned to growth last month for the first time since December, driven by gains in the UK and robust demand for electric vehicles, making up for weaker sales in Germany and France. According to the European Automotive Manufacturers Association, new car registrations rose 2.8% in March compared with a year ago. The growth in EV sales didn't extend to Tesla, which saw new registrations fall by 28% in Europe last month. President Trump is ramping up pressure on Volodymyr Zelensky to formally recognise Russia's occupation of Crimea. The US president's proposed peace plan, which appears to be backed by Moscow, would effectively freeze the conflict as it currently is.
I think we have a deal with Russia. We have to get a deal with Zelensky, and I hope that Zelensky, I thought it might be easier to deal with Zelensky. So far it's been harder, but that's okay. It's all right. But I think we have a deal with both. I hope they do it.
It's being reported that the British Prime Minister Keir Starmer and the Commission President Ursula von der Leyen will today conclude talks on a proposed EU-UK Defense Pact. It's expected the deal will be formally announced at a summit on May the 19th. It's anticipated that the arrangements would allow UK defence companies access to an EU-backed common defence fund.
Coming up on the programme, we've mentioned tech a few times. We will be talking about those fines. The EU hits Apple and Meta with fines. We'll discuss tech regulation on the continent. Plus, Europe's corporates had a relatively strong showing in earnings this morning. We'll check on the stocks at the open. Futures certainly a little lacklustre here, more so stateside. Up next, BNP Paribas CFO joins us. We'll be talking about the lender's strong equity trading performance. How sustainable is that? If you want to get involved in any of these questions, please get in touch. IB plus BBTV Go. That is the function to use. This is Bloomberg. Welcome back to the programme. This is the opening trade. 16 minutes past 7 here in London, or past 8 if you're over in Paris. Let's go to Paris now. In terms of the earnings story, we are going to talk about BNP Paribas earnings, and we're joined by the CFO, Lars Machenil. Lars, very good morning to you. Let's get straight to the positives here. First quarter equity and prime services revenue up by 42% year-on-year. That's much higher than the estimates. That's much higher than the average achieved on Wall Street. But, of course, the question is, how sustainable is that kind of performance?
Yeah, good morning. Indeed, well, if I take it just a step back, if you look at the total bank, we clocked in 3 billion of net profit, and indeed with a record quarter for CIB. Now, if you look at CIB in particular, we have 3 divisions, right? So markets, global banking, security services, and they've all been performing well. And if you zoom in on your question, if we talk about global markets, do remember that we have been completely changing our setup. We have the full width of products and of services, and therefore we intrinsically grow by taking market share. Again, this quarter, there was a very strong additional volatility. So we stepped up even in those results, and we have a record quarter. But nevertheless, I mean, we are on a strong growth, intrinsic growth, which was somewhat boosted this quarter given the exceptional volatility in Q1.
OK, so the exceptional volatility, of course, helped, but you sense you're taking market share, and so maybe some sense of sustainability to strong performance.
Yes.
What about the cost side of the business then, Lars? Because at the net level, the numbers look almost in line with expectation, but some people are citing that cost base, and just I'm wondering what it is that's going up year after year that you're having to pay out for.
Listen, if I take it back again at the BNP Paribas level, indeed, if you look at it, you see costs going up by 4%. So this is a number that is kind of high. But then if you look through it, there are elements which is basically the Forex. Yeah? So the Forex lifted it for 0.5 basis point. Then there is also inflation that lifted it for 0.5 basis point. And then also the variable costs that basically come with the strong results of the first quarter. So if you look at it intrinsically, cost evolution is 2.5% in the first quarter. And that is what we aim for the rest of the year. And that 2.5% growth is marginal cost. So it comes with cost to accompany the revenues. So we feel intrinsically that it is under control. There are some exceptional elements, call it noise in the first quarter, but we stick to, for the rest of the year, to 2.5% marginal cost growth.
Lars, good morning, it's Guy. Can I just take you back to the markets division? Is the markets division running at maximum risk at the moment?
Actually, we consider it runs at low risk. What I mean by that, when we talk about being able to step up market share, it basically means that we keep on doing exactly the same underwriting, the same kind of business that we do, but we take higher market shares. So if you look at the evolution of our top line in CIB, and if you look at the metric, whatever it is, but take the VAR, which is a metric for the risk that you take, the VAR is basically stable, whereas our top line grows. So we really stick to underwriting the same kind of business, but given the positioning, we take market shares.
If volatility comes down, could you take more risk?
Listen, we are really confident that the activity that we do, we consider it flow. And that flow basically means companies and institutionals, they typically need currencies, they need Forex, whatever it is. So there is a good play. And if you look at, what typically the outlook says, this business grows on a year-to-year basis, and we will continue to grow and to take market share. Again, we do this with the same cost of risk. Listen, we call our division CIB, Corporate and Institutional Banking. We don't call it investment banking, yeah? So we stick to our underwriting principles.
If volatility comes down and you're making less money on that side, does deal making go up? If we go into a more certain environment, will there be more deal making and less money coming out of the markets division? Do those two kind of compensate for each other in a more certain environment?
Yeah. No, that is typically what we do. You know, what we stand for is we have diversified but complementary kind of activities. It's true, like if you look at our results today, the markets activities were strong given the increased volatility in the quarter. However, if you then look at our global banking activities, and there you look at the demand for kind of mergers and whatever, that was lower given the uncertainty. So when that uncertainty will taper off, yes, indeed, the markets activities will probably normalize. However, there is a likelihood that the demand for whatever it is, investment banking, M&A activities, will step up. And that's, I cannot say it's every quarter like that, but that's, if you look at the trend of the last couple of years, that's how it has been.
Good morning, Lars. It's Lizzie here. Can I ask you broadly how you see this trade war and the general geopolitical uncertainty impacting economic growth and inflation as we go ahead?
Yeah, there's several things to that. I mean, it's probably a tad too early to say something. If you look at our first quarter results, you don't see anything. Yeah? Going forward, I basically, for the moment, I don't see many things moving. Why? On one hand, yes, with whatever the tariffs will come, some transatlantic volumes of trade will go down. However, if you look at Europe, which is putting all sails to reinvest, look at what Europe is saying, look at what Germany is saying, look at what several countries are saying. And so we anticipate that those investments will basically compensate. of course, tariffs will come immediately, whereas those investments will take a bit of time to come. But normally that should happen. I'll give you another thing that I look at on your cost of risk. As a front-leading indicator for me to see if companies run into trouble, I basically look at their liquidity. So if I look at CIB, if I take the corporates, if the corporates all of a sudden come rushing in with liquidity demands, that is kind of a hint that something is going. I don't see that. At the same time, if you go to the hedge funds, if the hedge funds all of a sudden have problems putting up the initial margins, that's also an indicator. I don't see that. So I don't see the corporates coming for funding needs, and I don't see the funds having issues with putting the initial margins down. So from that point of view, what I'm just saying that things could level out, at this stage, with all the indicators I have, that's what I see.
But, I mean, you are especially exposed among the European banks to this trade war. You've got a higher proportion of loans and advances to manufacturing than most of your rivals. Does part of that first quarter provision already include those risks? Are you going to have to increase it if the trade war kind of intensifies between the US and Europe?
No. Listen, let me clarify. If you look at our exposure, yeah, and you look at the sectors, and then you take the sectors that could be impacted by those tariffs, for us that represents, quote unquote, only 10% of our exposure. So from that point of view, I feel comfortable that Europe has compensating effects. And then for us, we are so diversified that we're not exposed in any material way to that kind of trading-related activities.
Lars, great to catch up. Always a pleasure. Thanks for updating us. BNP's CFO, Lars Machenil, BNP Paribas, out with numbers this morning. Let's talk about what else is going on in the markets. The big theme is basically what is happening with maybe the markets taming Trump. That seems to be the narrative this morning. The Citadel founder, Ken Griffin, sounding the alarm, though, on Donald Trump's trade war as markets seesaw in response to the latest signals from the White House. Speaking at the Singapore World Economic Summit, Griffin took aim at the US president's policies.
Unfortunately, the trade war, which has devolved into a nonsensical place, means that we're spending time now thinking about supply chains, thinking about strategically how we're going to source goods around the world. And I'll tell you what's not going to happen is people are not going to race to build manufacturing in America. Because with the policy volatility, you actually undermine the very goal you're trying to achieve.
But are we going to get some certainty from here on in? Is that the message from the last 48 hours? Valerie's here with more details.
Guy, it does seem like the stock rally has lost a little bit of steam, but look, on a three-day basis, we are still really bouncing strongly in the U.S. equity market, up near 4% in the last three sessions for the S&P futures. And take a look at how the dollar has rebounded from year-to-date lows, up nearly 1% now in the last three sessions after those year-to-date lows that we hit on late Monday's session. I want to argue, though, that this is all because we've hit peak policy uncertainty from the Trump administration. Take a look at this chart behind me. This is a economic policy uncertainty index. We did spike very largely, but we're now off the highs. It seems like the big message from yesterday is, yes, there's still maybe a bit to be worked out, but the clear direction is lower for tariffs. We're not going to get any retaliation measures. It's just going to be de-escalation from here, which should allow for volatility across assets to decline and maybe perhaps open up the door for a further equity rally.
Yeah, that does seem to apply to the China conversation if you take what President Trump has been saying at his word then, Valerie, but I wonder how much it implies in Europe. We'll certainly return to that theme because, of course, Europe escaped the tougher tariffs just at the last minute with that 90-day reprieve. Bloomberg's Valerie Teitel with the latest on the tariff narrative and how it relates to markets and uncertainty. Coming up, we'll discuss some of that market uncertainty. Lauren Van Billion joins us, fixed income portfolio manager with Allspring Global Investments. We'll get into that conversation next. This is Bloomberg. Welcome back. 7:30 here in London. This is Thursday, the 24th of April. Just a reminder, it's been a shortened week. It gets confusing which day of the week it is. But it is Thursday, and this is the picture for European futures. We are expecting to go a little bit lower. The pattern of trade yesterday on US markets, we closed out, and the US had a tiny bit further to go in terms of negativity, but not a huge amount. But we maybe have a bit of that to factor in. Plenty of earnings news, though, Lizzie, to factor in. And I should say we've had quite a lot of volatility in US futures just this morning. So they went down weaker than they are now. Now they're back to where they were around an hour or two ago. E-mini's down 0.1%. Nasdaq futures down 0.2%.
Yeah, if we look at the bond space, yields pretty steady at the front end here in Europe. Lower on treasuries across the curve this morning. A bit of relief, although, of course, there have been questions about their status as a haven. And we've also been hearing from the Bundesbank President Joachim Nagel about that. Here's what he had to say to Bloomberg.
It is not good news that there's a lot of, let me say, doubt regarding the safe haven of US Treasury. Some of that money went to German bonds. We need the US Treasury market as a good, stable market that gives a lot of, let me say, certainty. It is not helpful to all of us if there are some doubts, uncertainty around here about the US Treasury market.
So it wouldn't help the world if Treasuries lost their haven status, but are they losing that status, guys? It's a good job we've got an expert to tell us.
The fact that the Bundesbank's talking about this, I think is amazing. It's reached that kind of level that big central bankers, influential central bankers around the world, are talking about the risk that is currently unfolding in the Treasury markets. Plenty of people are talking about the fact that they're not a safe haven asset anymore. Lauren Van Billion, fixed income portfolio manager at Allspring Global Investments, is the expert that Lizzie's talking about, joining us around the table. No pressure.
No pressure.
Are Treasuries still a safe haven asset?
Absolutely. They're still a deep, liquid, highly investable market. But we are in
I'm sensing a but here.
Isn't there always? So that's where things get interesting. But there is a sense that the regime is not as straightforward, perhaps, that we're in a period of heightened uncertainty, heightened volatility. That's not going anywhere in a hurry. And given the sort of the risks into this year and into beyond, we think there's going to be pressure for steeper curves, particularly in the US. Right. It does make sense that people look to diversify holdings across jurisdictions, across countries, across asset classes.
Yep.
I think that move continues.
If the Fed cut rates aggressively at this point, I'm not suggesting that that's the kind of the base case, but let's say the Fed cut rates at this point. Trump is certainly putting pressure on. You talk about the steep curve. How much would the 10-year drop if global demand is beginning to dry up a little bit? Are we in a scenario where potentially actually the US 10-year yields wouldn't come down very much, despite the fact that the front end was moving quite aggressively, that curves would continue to steepen and potentially quite aggressively?
I have a lot of sympathy for that view. That does seem like the likely outcome. All the policy we've seen in the US so far this year has been very much on the downside growth risk front. Right? The market has focused on that in a big way. But as we move later into this year and into next year, there's where we could see a lot of the upside inflation risk coming through. So that does say to us at Allspring that, yes, front-end curves could be
Is it an inflation risk, or is the fact that the rest of the world is just not buying? That there isn't the need to buy US Treasuries in the way that there once was, to park money in the US in Treasuries that there once was?
I don't think that breakdown is super clear. Recent auctions, foreign demand has been there.
Yep.
Your marginal buyer of Treasury perhaps isn't as happy as they were a year ago, but they're still buying. I think that's not going to be lost overnight.
Okay, yes, and that's the sense we're getting from a lot of conversations, is that these things aren't changing overnight, which I think is really interesting. Going back to what we heard from the German Bundesbank, also we've been hearing from French voices as well, downplaying the role to which the euro or European debt could replace treasuries and the dollar as safe havens and things. I mean, help us understand that a little bit, because I suppose for the Germans there might be a temptation, they might like to be have a bit of that haven status. They've already had it in Europe for a long time, but they might like to have a bit more. They're going to spend a lot of money soon, and that would help to bring down their yields. So why would they push back against that notion?
I'm not sure it's the... Because I agree. I think that safe haven status, that increased bid for a European asset is super useful when you're talking about structurally higher spending patterns going forward. I think perhaps what's unsettling them is just the pace that yields have moved over the last 6 months. First that aggressive repricing, higher in European yields, as we start to talk about the debt brake and et cetera, and the way that that spread with the US collapsed again in early April. That round trip has been quite incredible. And I think it's that pace that's scaring them, not so much the overall level of yield.
OK, and Lauren, in your notes, you talk about the convergence of monetary policy, not the divergence. I think that's interesting because we've talked quite a bit about the US inflation picture and the European inflation picture look quite different, and it might be a lot easier for the European Central Bank to cut rates than the Fed. But actually, you're emphasising the weakness in global growth and the way that this is going to put downward pressure on rates in a lot of places.
That does feel like the way the market is moving. I think it's too early to call it a done deal. Soft data is absolutely weakening astonishingly in the US. We're not seeing that carry through to hard data as yet. But the Fed's been clear, right? Any cracks in the labour market, they are going to be easing policy.
But I mean, where markets are pricing in these faster cuts and long yields aren't playing along, is that curve steepening on economic hopes, or is it more warning signs flashing from deficits and geopolitics?
I certainly favour the latter. I think we are moving into that more structurally uncertain time, which then speaks to steeper yield curves. You've got to have that premium for holding that long end in times of elevated uncertainty.
I mean, the other thing I keep thinking about is, where we see gold climbing, maybe not today, I haven't looked, but, generally, it's as if the US is in recession, when even the IMF, gloomy as it is, isn't saying as its base case that the US is in recession. Is it that basically you're saying investors are getting shortchanged on the risk premium? They're overpaying for safety, but they're missing out on better compensated opportunities in lower rated credit?
Now, this is a good point, right? Where are you being compensated for risk? Because usually in this time of uncertainty, there's that kind of inclination to just rush for better rated assets. And here I think that's dangerous because you need to have a good team of analysts really diving into that risk reward. It's not as clear cut as move from a double B credit to a triple B credit. You're in a safer place. You need to be thinking about the issuer, the sector, how much you're being paid. So I think there's some really interesting opportunities there.
Lizzie was referencing their weakness in the economy. You talked about how the sort of at the coalface data, the high-frequency stuff, is looking quite weak in the US. I got myself overly excited about the Beige Book yesterday, and it turned out to not deliver anything very exciting. It said there was little change in economic activity. That's the backward-looking bit. But it did say that sentiment has really been hit by tariffs, and most businesses are planning to pass on increased costs to consumers, to their customers, which sounds pretty inflationary. I mean, where are you seeing those cracks most evident in the US economic machine?
Well, this is the problem, right? We're not seeing them yet in hard data. So that's those soft numbers, those confidence numbers, surveys have been, that fall off there has been incredible. But so far, the transmission into spending, into hiring, into labour markets is just not there. So keeping a super close eye on that, as I think everyone is in the market.
OK, Lauren, thank you very much. Lauren Van Biljon, the fixed income portfolio manager at Allspring Global Investments. Coming up, we'll be back to the earnings stories. We'll be speaking to the CEO of Delivery Hero. Nicholas Olsberg joins us on the back of the company's latest earnings release. This is Bloomberg.
.41 a.m. here in London. Welcome back to the opening trade. We're looking at futures pointing lower here in Europe. We're deep in earnings season. We just had numbers from Delivery Hero. First quarter gross merchandise value matching estimates, and TradeGate suggesting that the stock is going to climb at the open. We can speak now to the CEO, Nicholas Olsberg, who is the founder as well of Delivery Hero. Good morning. Welcome to the programme, Nicholas. I want to start with the theme, it seems, of this earnings season. Tariffs, of course. Are tariffs creating any second or third order impacts for your business? I know you're not perhaps directly as exposed as other companies.
Look, I'm sure there will be some effect into prices, but having run the business now for I don't know, we have a market that's been around for 25 years. We operate in 65 countries across the world. We cover markets like Argentina, Turkey. We were part of the whole Greece crisis, financial crisis. We have seen many crises over the years. But what you also see is that the food delivery is extremely resilient. So even if there are changes in pricing or GDP in a particular country, we rarely see any impact. So I would rather argue we are a little bit of a safe haven during these turbulence times.
OK, so not your first rodeo, but one place that you're exiting is the Thai market, so that in Asia you can kind of focus on more profitable markets. With that in mind, how's the Korean market? How's business in Hong Kong?
Yeah, so we decided to close Thailand, after a number of years operating there. I think we have drawn a lot of learnings what we've done. We grew the business incredibly fast over many years, but it wasn't on a sustainable basis. We did it a lot with vouchers, coupon, and so on. And that's a very expensive learning and lessons we have made. And we now decide to close and focus on markets where we have very good development. And we've seen tremendous development in Hong Kong. We have seen an APAC is coming back to growth. And recently we acquired also then Deliveroo in Hong Kong to further expand our business there. So we double down on the other markets in APAC.
Doubling down on other markets in APAC. What about the consolidation story we're seeing in this sector, Nicholas? We've heard, of course, that Prosus is buying Just Eat Takeaway. Is that the kind of consolidation you would expect to be repeated elsewhere within the sector? And what role will Delivery Hero play?
I think we've seen a lot of consolidation already. We have been part of a few, but the last couple of years, I would say we have stayed a little bit on the sideline. We have been very focused on our operation execution. I think you can see that in the numbers. But we have seen other players being consolidating around us. This is probably going to still continue. I think we would probably also remain on the sideline there. And rather focusing on our own business for now. But then there are always these small tuck-in things like buying Deliveroo in Hong Kong is probably an exception to the rule.
Nicholas, let's talk about what is happening within the business then. What's happening with inflation? What does consumer sentiment look like? What trends are you able to discern from the data that you take at the moment? What are you seeing in terms of what the future holds?
I see similar things that you do, that the consumer sentiment is probably a little bit weaker in some markets. But again, I know I've been operating the business for so long, and I've seen that we've been very resilient over the years for any crisis. Also, if you look at the last few years, our growth has been pretty stable. It's been deviating with a plus minus 1%. Over every quarter. Right now, we are rather on the plus side. So I think overall, we are a business that is very resilient for crisis. Again, we have been operating Argentina with hundreds of % of inflation, Turkey. We were in Greece during the financial crisis. All these businesses are doing tremendously well. So I think we are a little bit of a place where people go, even under crisis. People might go out less to restaurants, but they still order in. So we usually thrive also in this market.
Do you see a more fragmented world, though? You operate around the world. Do you see greater fragmentation or do you see consolidation? The world has been consolidating over the last few years. It feels like the world has got smaller, not bigger. But it feels like those barriers are being thrown up. Is that going to make it harder for a company like yours to operate?
I don't think so, to be honest. I think what we have also done, and I think I'm happy about that, is we've built very strong local businesses and local brands. So we have a very strong tie to the local markets, and we operate from there. So we don't have shipping between countries. We operate in the countries. So therefore, tariffs and similar is less impactful for us. Of course, if there are tariffs impacting inflation of food prices, that will also impact our consumers. But again, what we see is that consumers tend to go out less and eat during bad times, but they still order in. It's still perceived as cheaper to order in than going out. So we don't expect any negative impact.
Nicholas, great to catch up with you. Thanks very much indeed for the update on your business. Nicholas Osberg, the CEO of Delivery Hero.
Thanks to Nicholas for joining us. Let's get back to the market conversation. We're joined now by our Markets Live executive editor, Mark Cudmore, for 3 minutes on the markets. Mark, a lot of volatility in markets over the last 24 hours, twisting and turning based on all of the clues we're getting around the China narrative. Have you learned anything new of late around the direction of travel there?
I think possibly we have learned something new this week in terms that we have seen a point where Trump has clearly responded to market stress. I'm not sure I want to go so far as to call it the much talked about Trump put. I don't think there's a set level in the sand, but I think he realised that the news flow is sounding overly negative, and I think it's helped give Bessent a bit more sway in the White House administration, it seems, and therefore to kind of provide a bit more balanced tone. But we're still getting this massive policy uncertainty. I think that the kind of markets the last couple of days are set to persist, potentially for a number of weeks, although it's very hard to make a long-term call under this administration. Long-term is really beyond the next 24 hours, it seems, because there might be a whole new catalyst to change it. But the base case is the markets the last few days continue. What are those markets? They are kind of slightly whiplashy markets, but with an overall positive tone. And the reason I say that is that I think that there's going to be to and fro on trade negotiations, tariff deadlines, and the fact we're getting trade deals. I think the marginal news flow is going to be a net positive. It's going to run into the fact that the underlying structure is so brutally negative that it's not going to get us back to a good, bullish, positive story. But I think the relief rally overall is more to go in choppy conditions.
So is it just a mechanical uncertainty comes down, volatility comes down, risk goes up?
I think that's fair. I think that's absolutely part of it. I mean, there are some pure, as you say, you use the word mechanical there. People have vol-adjusted targets, and so essentially as vol comes down, they have to kind of allocate more risk. So there is a simple mechanical part, and that's not the large part of the market here. But that is simply the case that as we get some positive news flow, people have been trained over the last 15 years to buy the dip, like Pavlov's dog. And so therefore we get positive news flow. People are going to go, maybe the low is in, maybe we've seen the panic, maybe this is like 2020 in the pandemic, where March 2020 was just horrendous, but that was the low, and people who fought the rebound were mistaken and wrong. I think people are going to maybe buy into that narrative and get kind of enthusiastic. So I think that relief rallies can be quite powerful. I do think that the structural story remains very bleakly negative on a relative basis for US assets. And I think there's a lot of money, trillions of dollars, to come out of the US over the coming years. And that is a story that shouldn't be played out in the space of a couple of weeks or a couple of months, but it's a valid story.
Mark, I've checked it now. Gold is up again, more than 1%. Are commodities going to stay the refuge of choice?
Not all commodities, definitely. Clearly, precious metals might be one kind of haven. I think the kind of gold traders, have had a valid run. I'm not particularly excited by it at these levels. Remember, it doesn't yield anything. I think other industrial commodities are going to continue to suffer them. Not just oil, but copper. Many of these have suffered, and I think they've got much more downside ahead.
OK, Mark Cudmore, our executive editor for Markets Live, we thank you. And remember, you can get up-to-date analysis and insight from Mark and his team. Just go to MLIV Go on your terminal. Let's go now to our stocks to watch. Joe Easton from our equities team has what we should watch out for.
Morning, Lizzie. So Roche's numbers looking pretty solid out of the drug sector today. The sales rising pretty significantly and an 8% jump in the dividend as well. However, this stock has been a bit of an outperformer recently, so potentially there is a little bit of room for disappointment in terms of some of the top ends of the estimates on that. There was also some weakness in their diagnostics business over in China, according to analysts. And we have actually seen a few brokers coming in with sells on that stock recently, so potentially they might get a bit of downside on that one today. Then in terms of Unilever, they are raising their prices across a swathe of goods in the UK consumer staples company. And importantly, there's the big headline we've all been waiting for. The ice cream business is going to be called Magnum Ice Cream Co., beating out Ben & Jerry's and Cornetto, the other big brands. That's the headline that caught my eye. But the company raising its prices, and that could potentially boost the stock today. We did see it dropping yesterday in line with Reckitt Benckiser, which dragged the sector lower. We can see those two stocks on the screen there, so a little bit of weakness in there, but potentially this is going to be positive today, not just because of the ice cream news, though. And then in terms of banking, we've got BNP Paribas, the company's trading business, doing really well, particularly in equities, similar to what we saw out of the big US firms like JP Morgan and Morgan Stanley. So potentially we could see it catching up with some of the other French banks. There we can see SocGen, the real outperformer in that market, reports next week, but potentially BNP going to be a little bit stronger on at those strong trading or revenue businesses today in Paris.
Thank you very much. Joe Easton, with all the news you need about the stocks that could be on the move and the ice cream brands yet to come. We're learning a lot about the naming of spin-offs, aren't we, this week? We were talking about the auto sector yesterday. Yeah, it seems to be a lot of money in naming
Magnum
spin-offs.
seems quite straightforward.
That's quite straightforward. I'm sure it still costs a lot to come up with the name. We've got a few stocks that could be on the move. Joe's been through a lot of them. Roche, Unilever, BNP. We've got Adidas, Kering, Nestle. I know some of those could be in focus. Nokia caught my eye as well. They're guiding a little lower, and this is a tariff story. So getting to the top end of guidance could be a challenge. Profit guidance could be more challenging is the line there. And Kuehne and Nagel on the logistics side, just as we talk a lot about global trade, I'm interested in this. And I'm interested in the way that companies are handling the uncertainty. They're saying no change to the outlook, but then they're saying there is a greater degree of uncertainty. So we're sort of giving outlooks, but at the same time saying, you know, we're a little less certain in them.
UniCredit had a board meeting yesterday. Fascinated to find out what came out of that, and maybe we'll talk about that a little bit later on. US futures are a little negative at the moment, but the last couple of days have been so strong that I think
jittery this morning, though, haven't they?
Yeah, but you've had two back-to-back 2% increases. We haven't had one of those. Haven't had two of those back-to-back for quite some time. So I think inevitably you would fade that after two strong days. Now, where we go from here, I don't know. It'd be interesting to see how the rest of the session goes.
Interesting to see who's on the broadcast round. Is it going to be Bessent, Navarro, Lutnick?
Then we draw our conclusions accordingly.
Exactly.
Trump. There is only one voice that matters.
Yeah. Coming up
anyway,
then, we will have the opening trade for you. Futures are pointing a little bit lower. This is Bloomberg.
Thursday morning, good morning. Let's talk about Wednesday first before we get on to Thursday. A little bit of a history lesson maybe required. This was the European session, quite quiet for most of the session, but then we get this volatility around the back end of the session, which mirrors what we've obviously seen or is driven by what we saw out of the United States. The US kind of fades from there a little bit. We basically go out here. There's a little movement lower after that, and actually futures are lower subsequent to that. So, Lizzie, that probably points us in a slightly negative direction this morning.
Exactly. Mixed signals weighing stateside, mixed signals weighing here in Europe. Red across the screen, down 0.2% for Eurostoxx 50 futures. Not so bad out of London. The CAC, though, really down, CAC futures, despite those earnings out of Sanofi and BNP Paribas. Misery, though, from Kering. Anna, what stocks are you watching?
Yeah, in fact, some of the ones you just mentioned there, Lizzie. Let's dive into some of the stock specifics because they could be crucial. BNP Paribas, we spoke to the CFO a little bit earlier on. He was keen to point out that there is some sense of sustainability to the outperformance that they've had in equities trading. He says that's because they've been claiming market share by some of the changes they've done at global markets. So we'll see how the market responds to that 42% increase year on year in equities trading. Adidas in focus. Better than estimated numbers coming through there. Retro Samba's doing well, it would appear. It's been a really volatile stock, of course, and there's a lot of trade threat to that sector more broadly. So a lot in the mix. But Adidas could be an outperformer this morning. And Sanofi in the drug space then, Guy. Guidance confirmed at that particular business. Strong earnings as Dupixent, apparently. Sales there keep on growing. So that's what we're watching in terms of the stock specifics, along with Kering, as Lizzie mentioned.
Absolutely. Kering is going to be in focus. I think LVMH goes XD today, so just keep an eye on that. In fact, there's a lot of XD in the market, ex-dividends in the market this morning, which could complicate matters. OK, here we go. Time for the Thursday session. We are expecting a slightly weaker start to the day. Single stocks are important, as we've been pointing out. We're in the middle of earnings season. The bottom-up single stock story narrative is going to be there. FTSE 100 fairly flat at the get-go. It doesn't feel like... Today feels like a pause for breath after two really quite strong days, particularly out of the United States. 2% rallies in the United States. Haven't haven't seen that for quite some time. Have the markets got Trump under control? Have the markets tamed Trump? That seems to be the narrative that is emerging, but for how long is the key question. 600's down by around 0.2%. The IBEX is opening a little softer as well, but only a little softer. We're down on the DAX. The DAX clearly has no news today, other than Adidas and what else is going on. But the DAX is, can't remember the last time I saw the DAX opening this quickly. After the recent volatility, that is something of a surprise. But the CAC, it seems, is playing the DAX this morning and has got a little digestion issue to deal with before it opens up first thing. But there's plenty of stock stories within the CAC Quarante that are going to be worth focusing on. Lizzie, what's happening with the sector story?
Well, if we break it down as we await some of those to open, we've got about a quarter in positive territory. So energy leading the gains, utilities not far behind it, financial services also up 0.2%. But in the red, bottom of the basket, retail, banks, telecoms, consumer products and services. And if we just look over to some of those individual names that we've been talking about reporting results this morning, Unilever actually down 0.6%. They'd said that, you know, profit was meeting estimates in India, despite the demand slack. They had first quarter underlying sales at 3%, so beating estimates. And yet this morning, negative sentiment on Unilever. Nestle down 0.7%. They had their results as well. But those results pretty positive, Anna. Sales climbing on those higher prices for coffee and cocoa.
Yeah.
So actually a surprise there in terms of the stock performance, perhaps.
Let's have a look at some of the retail names and luxury names and how they're performing. We don't have an opening price on Caring, which I think tells us something, doesn't it, about where it might open. Trading halted on Caring, and Gucci, as you were explaining earlier, Lizzie, that the weak spot there. On the other side, though, Adidas doing OK, up by 1.5%. But that's interesting, isn't it? We're sometimes seeing this strong ADR performance overnight not quite translates into positivity in Europe. That certainly happened with a number of other names this week. But anyway, Adidas was up much more than that in the US stateside after those numbers dropped on the ADR. But the German listing then just up by 1.6% this morning.
Yeah, it's quite an interesting mix, actually. Technology stocks have bounced back quite strongly. That's another thing that's worth bearing in mind. Infineon is up quite strongly. ST Micro is having a relatively good day this morning as well. So that's interesting that we're rotating back towards that narrative. Some of the oil stocks are also having a fairly decent day. There's lots of ex-dividends out there. I just wanted to kind of flag that. But BNP Paribas is also down by 2.71%.
It is. So the banking sector is under a little bit of pressure on the back of the earnings story. Telecoms also under pressure. Nokia down by 5.6% as they've trimmed the guidance, the upper end of their guidance.
Yeah, we are waiting for Caring. You said that LVMH is ex-dividend today, but, you know, Burberry, Prada, both in the negative this morning. So off the back of those Caring earnings, perhaps, the negativity spread.
I think Dior's XD as well. Anyway, just folding that one in too. Sharon Bell's here, Senior European Equity Strategist at Goldman Sachs. Nice to see you.
Good morning.
Any early indications from the earnings season that's worth taking away?
I mean, the US earnings season so far has been OK, although pretty much all companies have taken away their guidance. A huge surprise there, given all the uncertainty. For Europe, difficult to say. We're so early in the earnings season. Less than 10% of companies have reported. And as you've seen this morning, it's been super mixed. Some companies reporting up a little bit, some companies reporting down. I would say figures had been coming down into this earnings season. So, and I don't think the first quarter will be that bad. You're not... The chaos related to the tariffs really won't affect the first quarter.
How reliable is guidance? Even if we get guidance, how reliable do you think it is?
I mean, pretty much all companies are saying that it's tough to do guidance, and where they can, they're often saying that they're doing it, not making large assumptions about where tariffs will go. So if tariffs change dramatically, clearly, even if you're not an exporter, you're likely to be an importer of goods, aren't you? So...
So is it useful?
Is it useful generally? A little bit. Is it useful at the moment? Much less than normally, which is why, of course, markets are so volatile right now. So much uncertainty.
Well, yes, some companies are putting out multiple scenarios, you know, like central banks. Is it, though, when you look at it broadly, more about supply chain issues or more about a potential demand slowdown when you think about how tariffs are going to impact earnings going ahead?
Yeah, we worry more about the general demand slowdown. So, absolutely, for certain companies, particularly if you're importing specialist products, etc., you know, tariffs can make a huge difference. But there's so much uncertainty about the tariffs anyway. What that uncertainty creates, though, is just lower investment, lower employment, lower demand generally. So I just think that it's probably that factor which will be more important, and be more important not for the first quarter earnings season, but for the outlook for the full year and maybe even next year.
Yeah, and it's also that uncertainty creating weaker dollar, stronger euro. How much do you think that's going to eat into, or already eating into, earnings growth?
Yeah, so I think there are probably two very big headwinds for European companies at the moment in aggregate. One of them is that sort of GDP uncertainty on demand, and the other is stronger currencies. And, of course, both the euro and sterling have been strong versus the dollar, and a lot of companies in the index are dollar earners of one nature or another. You could also probably add a little bit onto that in terms of a lot of companies do well when energy prices rise, and energy prices generally fell too during the first quarter. So energy prices down, currencies up. That's not a great mix when it comes to European earnings.
Let me ask you about some of the goals that we think the US administration is trying to achieve with the policies that we're mapping out, Sharon, and that you're analysing. We heard from Ken Griffin over at Citadel just yesterday saying that the trade war had got to a nonsensical place. He was praising of Trump on immigration and on cutting government waste, but then he was saying that he thinks that the US is at risk of undermining its own goals in terms of reshoring manufacturing by all of the policy uncertainty, a sense that things are just moving too fast, a lot of glass is being broken is the word he was using. I mean, what sense do you have about the direction of travel, what they're trying to achieve with this US policy?
So, I think clearly Trump's got lots of different aims with all of this. I mean, one of the aims, I think, is to bring back manufacturing to the US. Unfortunately, you create uncertainty and that reduces investment. But another aim is simply to raise money. He knows that he has a big deficit, a large amount of debt. He wants to cut taxes or extend the tax cuts. He wants to expand fiscally. How's he going to do that? While the tariff revenues will be very helpful in that regard. So I think he has aims with regard to all of this. But unfortunately, because it is quite a chaotic policy environment at the moment, companies don't know what to do.
Yes. And are you thinking about us being at peak tariff at the moment? It seems that the China narrative maybe is going in that direction. Certainly the US administration talking about how there are deals to be done in China and varying time horizons, but talking that way. But then you think about Europe. Europe got a 90-day exemption, didn't it, from the higher rate? So maybe they could go higher from where we are now. So how are you thinking about that?
I don't think we can say we're at peak tariff because at the moment a lot of countries are not seeing the tariffs they potentially could see. We probably were temporarily at peak tariff on Liberation Day.
Right, yeah.
We've receded quite a lot from that level, and, obviously we can ebb and flow from here, and I think that uncertainty just remains high for a period of time.
Do you think we're at peak uncertainty?
I think there's always potential for another injection of uncertainty with respect to all of this, but certainly if you look at volatility measures, etc., they are still very high.
Do you have an idea of where we're going? We're in a period of huge uncertainty. When we come through that, are we going back to US exceptionalism? Are we going back to US markets first? Are we in a more diversified geographical world? What are you thinking about us going to?
Yeah, so there is the uncertainty element. For example, we think there's a 45% chance of a US recession in the next 12 months. That's like a flip of a coin, isn't it?
Yeah.
That is clearly a very uncertain environment. But, yeah, in terms of where we're going to more medium term, we've been arguing probably for the last 6-8 months at least that you want to have a more diversified portfolio. You don't want all your eggs just in the US, and you don't want them all in the Mag 7 and the biggest companies. And in the end, the US market is super concentrated and very expensive, even though it's come down.
Yeah.
So I think that was always a risk.
So if money keeps coming out of American markets, you think?
I think we've seen that start. Yeah. And bear in mind a lot, if I look over 6 or 12-month horizons, money's still being flown into the US market. Yeah. You remember all the money that came in when Trump originally got elected. So I think it's got further to go, in our view, a little bit of a reallocation. I don't necessarily mean that the US will super underperform the rest of the world. It's just that it's had 12, 15 years of super outperformance. The dollar, US assets, US equities, this concentrated big cap tech, and I think it will be much less so going forward.
Sharon, I was drawn to one of the lines in your research. Often we think about energy prices, lower energy prices as maybe being something that's good for European earnings, but if you've got a lot of energy companies, then maybe it isn't. And you describe it as a drag on the European earnings story.
Yeah, I think it is a drag in the first quarter and probably will be a drag in the second quarter as well. We've certainly seen energy stocks see downgrades, and that reflects the moves down in energy prices we've had year to date. They're also dollar earners as well, in the way that they earn their money, and clearly, the euro and sterling have risen. So I do think it's a drag. That being said, of course, there are elements of the economy that will really benefit from falling energy prices. We've had gas prices, the TTF come down. We've had energy prices generally fall, and that will take a little time to filter into the consumer because often these prices are capped or set. But that will be helpful for consumption, yes, as will the stronger currencies in Europe too.
Sharon, great to see you. Thanks for coming to see us. We always appreciate it. Thank you very much. Sharon Bell, Senior European Equity Strategist, joining us from Goldman Sachs. Call 6 looks a little bit like this. Remember, you've got a bunch of XDs in the market. LVMH is the obvious one that stands out. Ferrari unchanged, but LVMH is down a little more than most, as you can see. But that is the XD process. It's interesting to see Novo falling as much as it is this morning. Anyway, Nestlé's out with numbers. It is reacting a little negatively, but fairly flat, actually, in a slightly down market. What else are we watching? Joe Easton's here with the details.
So a lot to choose from, of course, today, Guy, but Nokia probably a good place to start. The stock down around 6% at the moment. They have got positive news on a contract with T-Mobile, but actually a profit warning this morning, partly driven by the tariff outlook, saying that the top end of their guidance is going to be difficult to meet given the tariff worries at the moment. So that stock, one of the worst performers we've got on the market today. Then we've got Kering, again, another miss. The misses just keep coming for the owner of Gucci and Balenciaga. Not good at all in terms of the sales at Kering. Released last night, we saw the ADR dropping, and we're coming down pretty much the same over in Paris at the moment, down another 4%. Sharp losses for that stock over the past year, continuing, no respite for that stock at the moment. Then we've got Adidas selling all those Samba trainers, looking really strong on their results, making up, of course, from all the old Kanye West stuff that they no longer sell. We've seen Bank of America upgrading the stock today to buy, citing the strong organic sales growth, already upgrading the stock, moving up from neutral, and that stock gaining around 2% in Germany today, so pretty good on that one. Then in terms of BNP Paribas, now the net income was a miss, according to traders that I've been speaking to. That was one of the headlines we had on the terminal as well. And the stock did rally around 7%, I believe, into the results in recent weeks. So potentially we're just trimming those gains that we've seen recently. The trading business did look strong, but that net income headline seems to be the reason why the stock is lower in Paris. Then we've got ST Micro in chips. Everyone pretty much looking forward to this one because it is a bit of a bellwether in the chip stocks, smaller than the chip machinery companies like ASML, but the numbers looking pretty good. The forecast looking relatively strong, but only a 2% gain for that one. Not the biggest move, but it is positive at least for ST Micro. Then your Ray-Ban sunglasses over at Essilor, not selling enough of those heading into the summer period, according to analysts at Essilor, dropping. That is a big company as well. Of course, they do have the core glasses business, not just the leisure business as well. So that is looking pretty weak overall. The sales not actually living up to the top end of expectations. So Essilor among several stocks dropping today over in France following their earnings.
OK, Joe, thank you very much. And all of those movers adding up to a slightly weaker picture for European stocks, down 0.3% on the stock 600. US futures also pointing a little bit lower. Coming up, we'll dive into the luxury sector. More trouble at Gucci, as Joe was saying, as Kering struggles to revive its biggest luxury brand. We will have details next. This is Bloomberg.
Welcome back to the opening trade. We're 17 minutes into today's session, and it's not looking like a pretty one. We're 0.4% down on the stock 600. Particular underperformance this morning out of Paris on the CAC 40, down 0.7%, and that is not helped by Kering, the Gucci owner, of course. Those shares down more than 4% as things stand after they reported a 25% sales drop at Gucci in the first quarter. Now, the luxury giant really is struggling to revive its biggest brand, and we can talk now to Angelina Rascouet, who's been tracking that turnaround or the potential efforts at a turnaround. Angelina, good to have you with us. Just talk to us about these Kering results. What's so difficult at Gucci to turn the ship around? They've got a new face in terms of the creative direction. Why isn't it making a difference yet?
Hi there. So indeed, I mean, the quarterly results at Gucci were very negative. They fell 25%, which was slightly worse than expected. Gucci has been in turnaround mode for the past, I would say, 3-4 years. They named a new designer last month, Demna. He comes from Balenciaga, so he'll take over from July. But basically, before Demna, there was Sabato De Sarno, who spent about 2 years there. So that's actually quite a short time to turn around the brand. And Demna, I mean, yesterday we got indications that his first creations will probably be presented in September. So I think that's something investors were also waiting for, because there was uncertainty whether he would put out his first collection maybe in September or in February next year. So and you also have to take into account that when a designer presents a collection, you have to count about 6 months before the products hit the stores. So at least we got that. But overall, I mean, the past year, shares are down more than 50% at Kering.
Actually, let's talk a little bit about LVMH. Ex-dividend today, so the stock is a little lower, but it looks like it's going to be raising prices in the United States. Hermès has already indicated that it will do so. Do we know whether the price hikes will compensate for the tariff hit?
Indeed, I mean, yesterday we published that Louis Vuitton, so that's the biggest brand inside LVMH, is increasing prices. It sounds like it's about 4-5%. So actually, in the grand scheme of things, it's not huge, because luxury brands, they do that on a regular basis anyway. So because they have pricing power and they know that. However, in the past few years, luxury brands have increased prices by a lot. So it's a delicate move. An analyst said it sounds like the price increase of Louis Vuitton in the US are almost negligible. So we'll see what happens. But indeed, as you say, Hermès last week announced that on May 1st in the US, they'll fully compensate the 10% tariffs that have been applied on European goods.
Thanks very much, Angelina. Bloomberg's Angelina Rascouet joining us there with the latest on the luxury sector. Sticking with the consumer themes, Adidas reported better than expected earnings yesterday, boosting the firm in the competitive footwear space. It was after hours yesterday, so the stock just responding this morning, up 1.8%. Charlie Wells is here with an earnings update on this business and some others that have caught his eye. Is Adidas getting it right then, Charlie? Good morning.
Good morning. You know, they're giving the consumer what they want, and what the consumer seems to want right now is these kind of retro sneakers or trainers, if I need to translate, which I know
yes,
I don't.
Please. Thank you very much.
But they're giving the consumer what they want, right? They're these sort of, you know, the Samba, the Gazelle, the Taekwondo, and these are kind of more classic looks. And I think sometimes in periods of uncertainty, the consumer turns towards that more kind of retro look, because they're not worried about, you know, how, you know, trends could change quite so quickly. And it's also interesting, I mean, Adidas...
That's quite cute, isn't it? The idea that you feel safe.
You look back.
Yeah, there we are.
A company that doesn't feel safe right now, though, is Nike, right? And so this is such a competitive space. There's a lot more kind of entrants coming in. And we've just kind of seen, you know, Nike's share price go down. We've seen Adidas share price go up. And it's just, you know, I think delivering on what the consumer wants. I think Nike has struggled with that. We're seeing Adidas succeed there.
And let's just talk about Unilever, Charlie, because we know there's a new CEO there. They've beat estimates for sales. You know, we were just talking in the break about whether, you know, you've got to buy soap no matter what. Is that the key to this solid quarter for Unilever.
So, yeah, I think it's a continual kind of purchasing, not just of the basics, but also premium products. And so this is funny because consumers are kind of telling us in a lot of consumer surveys that they don't feel great. That's out in public. In the bathroom, they're spending more on higher quality products, right? And so that seemed to have given Unilever a little bit of a boost. Where they saw some weakness was in emerging markets. And that's important for this company because that's about 60% of their revenue. So we're going to need to look out there going forward. But interestingly, you know, they maintained guidance for the year ahead.
Let's continue down the shopping aisle and talk a little bit about what's happening with Nestle. I see the headline this morning. I'm not happy about it, to be honest. Nestle sales rise as it delivers price hikes in coffee. Pretty serious on this shift, generally. And also in cocoa products. These are two important things, Charlie, and they're raising prices on them.
They are crucial, and they are not going to eat those costs, pun intended. They're going to pass those on to you, and they feel like they can still do this. And interestingly, you know, Nestle also maintained their forward guidance. They said that if tariffs, you know, affect them negatively, they have strategies that they can deploy. I think a lot of those strategies mean passing on costs to the consumer, but they need to be careful here because Nestle has been on this journey. They had a really difficult, say, 2022, 2023, 2024, because consumers started trading down, right? They, instead of just saying they felt bad, they actually, you know, traded down, whereas it doesn't seem like that's happening quite yet. So this is a balance that they've got to strike.
Okay. You keep taking away the coffee and the chocolate. I don't know what I'm going to do. I'm not sure you can. I'm not sure how. These are necessities. These aren't. You can't trade down.
Grumpy enough?
I love cheap chocolate.
I'm also about coffee chocolate, which is actually something that I'm not very keen on. But
that sounds strange.
Well, it is, and coffee ice cream as well. These aren't good things. But coffee and chocolate are two staples. Raising prices, this is serious business. Charlie, thank you very much indeed. We've got comments coming through from China. We've had two briefings this morning. I think the message from both is fairly similar. Basically, the US needs to make the first move. There is this expectation, it appears, in Washington that China is the first one that needs to pick up the phone. But China pushing back on that line pretty strongly this morning. Yeah, we're hearing from China that the US and China are not yet in talks on tariffs. And this contrasts with what we heard from President Trump yesterday. President Trump was saying that there is direct contact every day between the US and China. Scott Bessent, though, did say that there was no contact. He said that Washington and Beijing were not talking. So this is in line with what we heard from Scott Bessent. So clearly nothing is happening at this point, at least according to these two voices. And China keeps making the point that more respect needs to be shown towards China as a precondition. And I wonder how that lands in Washington. I wonder how that gets translated into verbal communication in Washington. I wonder what that looks like.
Do you know what they like to say out of Beijing? We've been here for 5,000 years. You'd better respect us. We can weather this.
So it's really interesting, actually. Xi Jinping's drawing a lot of kind of similarities at the moment with Mao and the positioning of Mao in terms of standing up to America, standing on 2 feet, I think he talks about, and wanting to have that independence. And I think it was a journal this morning had a big piece on the fact that China has basically positioned itself and got ready for a conflict with Trump on trade and therefore is willing to stand up and is not going to back down, is not going to be the first one that blinks in any kind of a trade conflict. Yeah, China's saying that the US should revoke all unilateral tariffs and accusing this, calling it a tsunami of tariffs and saying it goes against the WTO. We won't get into that, perhaps, when it comes to China and the WTO, because I know the US takes issue with China on that front as well. But where does this leave us? I mean, we had an interesting conversation about whether we are at peak tariff with Sharon Bell. She didn't feel comfortable enough, Goldman Sachs, not comfortable enough saying we are, because even if they come down on China, there is still this potential for them to go up elsewhere.
But you made a good distinction between peak tariff and peak uncertainty, and the more Trump flip-flops day to day, I feel like the less market reaction maybe there will be over time.
But there's also a line at which you're pushing on a piece of string. Are you at 70%? Does all trade between China and the US stop at 70%? Let's call it 80%, or is it 90%? We're at 140%. You could bring back tariffs an awfully long way and still roughly have the same effect in terms of the narrative around trade. Yeah, other media, so this is not our reporting, but other media were talking about tariffs coming down to 50 to 65%, or maybe having a tiered approach on some goods that America cares very much strategically about, and others attracting a lower tariff. So we'll see if that comes.
Crucial, importantly, for how much dumping there is into Europe.
And so on that note, it's interesting to see the UK potentially looking at the de minimis rule and potentially changing that as well. Coming up, EU regulators imposing big fresh fines on big US tech. We'll talk about the impact of that next. Zach Myers is going to be joining us. This is Bloomberg.
Welcome back, everybody. This is the opening trade. We're 30 minutes into our European session, and the picture looks, well, pretty red, doesn't it? The stock 600 down by 0.5%. Some of the losses, I was going to say the worst of it coming in Paris, but that's not the case. They're equally bad in Paris and Berlin. So the CAC 40 and the Xetra DAX both down by around 0.75% as we digest results plenty this morning from the banking sector, the luxury sector and elsewhere. Lizzie, you've got a big mover from the telecom space.
Well, yeah, it looks like, as we were discussing with Sharon Bell, Anna, that tariffs and how you weather them are going to be what separates winners and losers in this market. And Nokia saying in its results this morning that meeting their top end of guidance is going to be more challenging because of the tariff uncertainty. And so those shares down 6.4% after this first set of earnings from the new CEO. Guy, what are you watching?
So what I'm watching is BNP Paribas. We were speaking to Lars Machinel. He's the CFO of this business a little bit earlier on. The headline that stands out from this business today is the fact that traders have had a really great time. They talk about exceptional volatility at BNP Paribas, and they have outperformed it and taken market share within the markets division. That's all great. The problem with that is that it is uncertain and volatile, and we don't know where it goes quarter to quarter, year to year. And the market's therefore looking at other things. Costs are up. That's not necessarily something that when you look at a bank you want to see necessarily. You want to see cost pressure and cost lower. And you're also looking at the kind of the net income line, and the market's not actually happy with the underlying picture this morning in terms of relative to expectations. So yeah, the kind of the shiny thing is the fact that traders are doing very well in this current environment at BNP Paribas, and they are taking market share. But the more sort of stable part of the business, the bit that you look at as an investor, if you're a longer-term investor, maybe that's where the concern lies, particularly around the cost side. And it's interesting to see BNP Paribas therefore falling by 2.75%, Anna.
Yeah, because Lars was trying to stick to the cost guidance, wasn't he, and suggesting that some of those costs were going up because of the higher revenues, and the two were sort of matching each other and linked. But anyway, the market drawing a different conclusion. So we're deep in earnings season. We have earnings coming from the tech sector over in the United States a little bit later, from Intel and from Alphabet. Let's park the earnings story, though, and talk about other tech-related issues right now, because this week we've heard from EU regulators that have levied fines totalling €700 million against Apple and Meta under the Digital Markets Act, the DMA, that new piece of much fanfare, the regulation that the Europeans have brought in. Now, Meta has accused the EU of effectively imposing a multi-billion-dollar tariff on the company. You wonder to whom that word is aimed, whilst a spokesperson for the Trump administration labelled the act as, quote, discriminatory. Apple and Meta are required to comply with the EU decisions within 60 days. Joining us now with some analysis is Zach Myers, Director of Research at the Centre on Regulation in Europe. Zach, nice to speak to you. So I read a story that involves numbers in millions connected to Apple and Meta, and I'm immediately thinking, is that really a big number when you're dealing with businesses as large as this? Give us a sense of the scale here.
Look, I think when you look at past antitrust fines in the EU, they're often in the billions, tens of billions in one case. And so there really has been a sense that the Commission has been quite careful in how it's calibrated these fines, not only about the amount, but also the timing and the messaging around them. You used to see Margrethe Vestager, the previous competition commissioner in Europe, announcing these fines with a great deal of fanfare, and these fines were not announced by the commissioners. They were nowhere to be seen at the time, and the amounts are significantly lower than some pundits might have expected. OK,
so they're lower than some had expected, lower than we've seen previously. Are they going to be in any way successful at driving change in business models? Because that's, one assumes, what the Europeans want to do here. So they want Apple to change the way that it allows downloads of apps to take place, to give other options to the App Store. It wants Meta to change the way it uses people's data or give them more optionality around the use of their data. Is this going to drive change?
I mean, I think it depends what sort of change you want to see. So the idea of the Digital Markets Act is to break open some of these US platforms to give users in Europe more choices. And I think it's worth noting that many of the beneficiaries of this act are going to be US tech firms. You know, there are many who are campaigning in the US for exactly the same sort of legislation because they don't want to be beholden to Apple or Google, to be paying them 30% of their revenues merely because they're using or forced to use those companies' payment systems and app stores. So whether we see real change, I don't know. I think that these are quite technical decisions. The changes that the companies have to make is quite complicated. There's many ways in which you can introduce friction to discourage users from going outside the Apple and Google ecosystems. But I think it certainly is the European Commission's hope that we see lower prices for digital services. What I do think, though, is that there's increasingly a worry that being reliant on US tech firms, even if they are regulated and even if they are forced to be a bit more open, is not something that Europeans can have trust in the long run if the US president is prepared to retaliate against what they see as unfair fines.
Yeah, I mean, do you think that the EU is underestimating the potential for retaliation from the US when you've got these big tech names like Meta being so vocal in their response to this move?
I mean, it's fascinating because among the US tech firms, different CEOs are taking very different approaches, right? Like, obviously, they have to align with Trump to some degree, but some are doing it more enthusiastically than others. And I think in the long run, it seems to me that greater transatlantic tension is not really in the interests of these tech firms. They get 25 to 30% of their revenue from Europe. Creating this kind of a seamless a way of doing business across the Atlantic as possible seems to be in their interest in the long run. And, you know, if this spills out into part of the trade war and leads into tariffs or restrictions on, particularly in Europe, on the use of US services, I mean, that would be damaging for the European economy, but it would also be very damaging for these US firms who get so much of their revenue in this continent.
Well, yeah, because Meta's kind of saying that you've got a double standard for US versus China and Chinese and European firms in the tech space. Is there truth in that? Does it kind of change the landscape for competition, to go back to what you were saying, Anna, in the global tech space?
Well, look, the Digital Markets Act does pick out a number of very large companies and set some special rules on them because of their assigning them certain responsibilities because of their role in the marketplace. And obviously most of those are going to be US tech firms, not exclusively, though. Booking.com, a European company, is also among the regulated gatekeepers in Europe. And, I mean, I can see why US firms might deem that to be discriminatory, but, I mean, these are the largest firms. They have significantly more power than others. And when you look at US companies, smaller tech firms that are really struggling to get a place in the market and to be successful and profitable because of some of the practices of these really large firms, I mean, I'm not really convinced that it's discriminatory rather than just identifying conduct that is, at least in some cases, problematic.
Is the DMA a non-tariff barrier?
No, I mean, when businesses...
Trump's going to see it as no.
Yeah, of course he will see it that way. But when you do business as a country, in a foreign country, you're going to comply with that country's laws and regulations. And
he doesn't like VAT. He doesn't like all kinds of things.
Well, exactly.
There's a whole kind
the
of
majority of countries in the world have VAT,
precisely,
right?
But that's why I asked the question: is that how deep and wide is the bucket that is a non-tariff barrier?
I mean, I think for Trump, it's anything that very large companies whose CEOs are close to him complain about and don't like.
So DMA could be in that bucket?
Exactly. But so would VAT, so would be digital services taxes, and, you know, some of these maybe...
Do you think it's on the negotiating table, therefore, when it comes to any kind of a trade deal?
Absolutely not. I mean, when you look at some of these laws that have been passed in Europe in the last couple of years, they're really tackling problems that Europe has been concerned about that strike at the heart of European values, things like fair competition, online safety, data protection. You know, these are not principles on which the European Union is going to be willing to compromise. And similarly on VAT, it's such a fundamental part of the tax structure.
Are trade deals possible, therefore, if these things are included?
I don't know. These things are not on the table whatsoever. I think Europe might be willing to compromise by doing things like committing to buy more LNG. You know,
sure. Yeah, that's easy.
Exactly.
But if the Trump administration, if the breadth of the discussion incorporates things like VAT, why shouldn't it include the DMA? And if they are on the table, is a deal possible? Like, I'm just curious as to what you're hearing in Brussels, and what are people talking about in terms of the flexibility that exists within Brussels to get a trade deal done. Were all these things to be on the table?
I mean, these are not on the table because these are laws that have passed through the European Parliament, through member states, through the European Commission. And the ability to backtrack on any of these is going to be extremely limited, not least because members of the European Parliament are deeply wedded to a lot of these laws.
So this could be why we're not at peak tariff then, because...
Precisely.
Yeah, we might not get deals.
Well, one thing...
Exactly, and I should just say, too, that, I mean, there are more fines coming down the table, right? Coming down the line. So there are 2 investigations against Google under the Digital Markets Act, another one against Apple, which is likely to be much bigger than this one. So I absolutely don't think there are a peak tariff.
I was going to say, one thing that there is talk about is a harmonised digital services tax in response to the US retaliation against the DMA. Do you think that would be the EU's next step here? Or do you think that they just carry on down this road of tightening enforcement?
I mean, I don't think enforcement is necessarily going to be tightened. I think the Commission is putting its head down thinking, we've got this law, we have to implement it. As opposed to the US, which now looks like a much more volatile policy environment, we are going to follow the rule of law and be as impartial as we possibly can. I think, you know, there is a legitimate justification for there being low fines in this case because you're dealing with a new law. The non-compliance period has been quite short in comparison to some of the other antitrust investigations that were carried out in the past. And so, so I don't think that enforcement is going to be politicised to any great degree.
It's quite quick, this, is it? Is this quite quick compared to other cases?
Yeah, but the Digital Markets Act is designed to be much quicker than antitrust.
And that makes a
difference.
difference.
You often see cases that take 10+ years to get to conclusion.
It's been, what, a couple of months?
Yeah, I mean, it came into force last year, so this is extraordinarily
quick. In terms of this case in particular, how quick, in terms of the ruling coming down and the fine being issued, that's been...
You're talking a couple of months.
Yeah.
So it's extraordinarily quick by European Union standards.
Yeah. By European standards.
Exactly, yes. But it's for a digital services tax. I mean, this is something that the Commission is going to threaten because, you know, the existing laws are the baseline. That's not up for negotiation. But maybe whether or not there is a uniform or more stringent digital services tax is something that could be threatened and then taken off the table as part of a trade deal. I do think that that it's going to be rather complex for the EU to implement. Taxation isn't a competence at the EU level. It's one for different member states. And so you would, the way in which that tax would be structured is something that, you know, it's going to be easy to threaten and hard to implement.
This whole thing is slightly mind-bending anyway. Zach, thanks for helping us provide some clarity. Zach Myers, Director of Research at the Centre on Regulation in Europe. Thank you very much indeed. What have we got coming up for you? We've been talking about it already. BNP Paribas dropping off the first quarter net income dips. We're going to hear from the CFO. We've spoken to the CFO. We'll go back and analyse what he had to say in just a moment. That's next. This is Bloomberg. Welcome back to the Open Trades. We are 45 minutes into the equity market session here in Europe. A little bit of weakness. We're down by, let's call it circa 0.75% across the broader indices. Some markets having a more favourable day. Look at what's happening in London. We are continuing to watch, obviously, what is happening with the corporate news. Just a bit of kind of geopolitical news that may be worth just referencing. China saying it has tracked a US destroyer which has passed through the Taiwan Strait. I think this is the second time in the Trump administration that we have seen that freedom of access story coming to the forefront. But it obviously comes at a very tense time, given what is happening elsewhere with the China story.
Let's get back to the earnings story. BNP Paribas, as you say, is one of those names that is dragging on the CAC Quarante this morning. Shares down more than 3%. It reported a dip in net income in the first quarter. But the French lender posting a record 42% surge in equities trading revenue. And we were speaking to the CFO, Lars Machenil, earlier. He said that, quote, exceptional market volatility has been giving his bank a boost.
When being able to step up market share, it basically means that we keep on doing exactly the same underwriting, the same kind of business that we do, but we take higher market shares. So if you look at the evolution of our top line in CIB, and if you look at the metric, whatever it is, but take the VAR, which is a metric for the risk that you take, the VAR is basically stable, whereas our top line grows. So we really stick to underwriting the same kind of business, but given the positioning, we take market shares.
If volatility comes down, could you take more risk?
Listen, we are really confident that the activity that we do, we consider it flow. And that flow basically means companies and institutionals, they typically need currencies, they need Forex, whatever it is. So there is a good play. And if you look at, what typically the outlook says, this business grows on a year-to-year basis. and we will continue to grow and to take market share. Again, we do this with the same cost of risk. Listen, we call our division CIB, Corporate and Institutional Banking. We don't call it investment banking. Yeah, so we stick to our underwriting principles.
If volatility comes down and you're making less money on that side, does deal making go up? If we go into a more certain environment, will there be more deal making and less money coming out of the markets division? Do those two kind of compensate for each other in a more certain environment?
Yeah. No, that is typically what we do. You know, what we stand for is we have diversified but complementary kind of activities. It's true, like if you look at our results today, the markets activities were strong given the increased volatility in the quarter. However, if you then look at our global banking activities, and there you look at the demand for kind of mergers and whatever, that was lower given the uncertainty. So when that uncertainty will taper off, yes, indeed, the markets activities will probably normalize. However, there is a likelihood that the demand for whatever it is, investment banking, M&A activities, will step up.
So, an optimistic BNP Paribas CFO Lars Machenil there, but the share's still down 2.75%. Why? Let's get analysis now with our UK and Middle East finance team leader, Jenny Serrain. Jenny, you heard there this discussion about volatility being good for equities trading in the first quarter, but then we're asking what happens beyond that, and still Lars is optimistic. Is he right to be?
Yeah, no, I think it's a really good question and a really good point about the divergence. I think investors don't love huge swings in trading revenue. It's just not something that's very durable. So to the point that you guys were making, it's not something that can last as long as if volatility does recede. There's also an argument about kind of the right amount of volatility. So too much volatility, and actually investors will stay on the sidelines. And so I think there's just this feeling that, you know, trading revenue, while really good in the first quarter, that's not something that can always last. And then you saw things like costs really ticking up and some of those more sticky elements. And so I think that's what investors are reacting to today.
Yeah, he was trying to say that some of that strong performance could be sustainable with increased market share. And he was also, I was asking about the cost side, Jenny, and he was saying, you know, some of that's just a reflection of higher revenues, but this seemed to hit the bottom line. So something on costs is worrying the market.
Yeah, definitely. I think especially in an era where, you know, you might see stickier and stickier inflation, is this going to be something that hangs around for many years now? That's really what investors worry about when it's something that's long-term versus something like trading revenue, which, while it had a really stellar, outstanding quarter, that's just hard to do quarter in and quarter out.
It's about UBS. I think its numbers out next week. So we're going to focus on that story. Tying up with General Atlantic, the credit story is something that a lot of banks have talked about. Talk us through why this one looks good and why it appears to be working.
Yeah, no, I think it's interesting that this is yet another example of a bank going out, tying up with a private credit firm. It sort of shows that they're still interested in doing private credit, even in an uncertain economic environment. You have to remember that this is still a relatively kind of nascent area. The fact that banks are still kind of putting their money where their mouth is a good sign. It's still early, though. We still haven't seen a lot of proof points into how these partnerships are actually working out. So I do think that'll be an interesting question, especially if we head into, you know, a recession in the U.S. or something else where the kind of credit quality of these loans starts to look a little worse. But it's sort of interesting that they would still even have the confidence to go out and do something like this. So that's certainly kind of a proof point in favor of that nascent industry.
And Jenny, can we just talk about UniCredit as well? Because they had this board meeting yesterday talking about, you know, what to do after the Italian government imposed all these hurdles on their takeover bid for Banco BPM. Is the meeting a sign that they're not in limbo anymore on this?
I don't think so. I think we're still squarely in limbo territory. I mean, obviously, I think there's the Generali meeting later today, so Italy is sort of in this, you know, bigger quagmire of deals, I would say. But I think Andrea Orcel has made it super clear that, you know, he's unhappy with the way that Italy has imposed this Golden Powers rule. And I'm sure, you know, I think our reporting yesterday was that was what this meeting was about, was just discussing, you know, what options they have. But I think it's still certainly in limbo state.
Just briefly, Jenny, on that, I mean, we had a Bloomberg opinion piece out, I think, saying that the way that the Italian government is imposing these rules could have a negative impact on willingness to get involved in the banking sector in Italy, or appetite for that. Yeah. Is that something you're hearing?
I think there's this bigger argument going on about consolidation among European banks, and certainly this Golden Powers rule imposition would make that seem less likely going forward. And so
as much as European banks do seem to want to kind of present a united front, get bigger, be able to compete better against the giants of Wall Street, there's still these little things that continue to hang up these deals. And so it's definitely something that, you know, the entire industry is kind of waiting with bated breath to see how this works out.
OK, thanks very much. Bloomberg UK Middle East Finance Team Leader Jenny Serrain, but clearly very across a host of other geographies for us this morning as well. Guy, there are data points and earnings stories to think about when it comes to the day ahead.
So I'm going to be doing the pulse today. Clement Fuss is going to be joining us very, very shortly. We'll talk about the IFO numbers. What is happening in Germany, I think, will be really interesting to watch out for. So that's coming out a little bit later on. You've got US durable goods. It's Thursday, so you get claims. We've got a US 7-year auction as well coming up. You've got plenty of earnings that we need to think about. What's Val watching? What is Valerie Teitel's radar telling her to pay attention to today?
Well, for today, Guy, my eye is going to be on jobless claims. I think we're still waited with bated breath for this, you know, significant hit to sentiment to show up eventually in a weakening job market. It might be too soon for that, but I think the market is still waiting for some of that weakness. And I know you talked about the Beige Book. The Beige Book also did show that even though sentiment is declining, you know, the employment indicators that they saw actually were still holding up okay. So when does that narrative start to break down? The first hint would probably be in a weak jobless claims print. So keeping our eye on that one today at 1:30.
And Guy mentioned the auction that's happening. We had one yesterday. Didn't go so badly, did it? Do we need to be worried?
No, pretty solid auctions at the moment. I think the market has pretty calmed down on the fears that there might be some buyer strike going on with foreign demand. Seems like foreign demand is holding in pretty well. But I think, you know, if we bring this big argument back to, you know, this exodus from U.S. assets, whether that's going to continue or not, I think it really does come down to the fact of whether this policy uncertainty is going to continue or whether the peak policy certainty is behind us. And Guy, I know we were talking before, I think there really is an argument to be made that policy uncertainty, we've passed the peak. Perhaps we see, you know, volatility decline across assets and that being a way for risk assets to rally. Because it seems like the big takeaway from yesterday, headlines all over the place on tariffs, but it seems like the direction is clearly downwards.
But what are we going to? OK, so we go to a lower volatility environment. Does that mean we go back to US exceptionalism? Does that mean we go back to the playbook we had before? Do you buy the dip in this kind of environment? Or are we in an environment where things have changed and actually we end up with less extreme divergence between US assets and the rest of the world? Because that would imply money continuing to flow out of the US.
Yeah, and there's an analogy you can make probably is that, you know, of a tsunami. Like the earthquake has happened, we're sitting on the beach still happy, but this massive tsunami is really yet to hit us. And I think people are pointing to this US-China container shipment data we've been getting recently. Some data pointing to the shipments from China to the US down some 60% in the last 3 weeks. Even the New York Post reporting that Hapag-Lloyd said its customers canceled 30% of their orders from China since the tariff announcement.
And our reporting suggests that perhaps some of the retailers going into the White House and saying, look, shelves are going to be empty soon on certain products, obviously, and maybe that's having an impact on Trump. It's interesting thinking about where these trade deals go, because on China, we heard from Bessent yesterday saying that it could be years before we get some kind of China deal. And on Europe, we were just having a conversation about the things that, from a European perspective, are not on the table in this trade deal, which makes you wonder whether we ever get one. And there we could see tariffs rise again, because Europe benefited from that sort of stay of 90 days.
Yeah, I think it's going to be interesting just watching the market reaction after this first, you know, letter of intent is signed on one of these trade deals.
It's 100 days next week.
Do they see it as a good thing, or do they read through the bottom lines and become more worried about it long term?
But it's 100 days next week, isn't it? What has he got to show for it? Is he going to have to get a deal by then?
We will see what the conclusions are, what the argument is, the story that is told around the first 100 days. Valerie, thank you very much. Bloomberg's Valerie Teitel, of course, with us. Later today, we'll have full coverage from another part of the world where they're dealing with a lot of the same subjects. Busy in Washington, IMF and World Bank spring meetings taking place. A host of names on deck to talk to Bloomberg TV. So do stay tuned with us for that. This is Bloomberg.